Risk is unavoidable, but the real question is whether or not the risk that you're taking makes sense for where you are in life. There are different stages of life, and with those different financial journeys that you're on, each one requires a different level of risk, right? So we're going to talk about different stages of life and, the conservative versus aggressive approach and which one might be best for you. Welcome into Perfect Game Retirement. Glad to have you again. Ben George with Ryan Ledden at Black Oak Asset Management. And talking about risk, Ryan, we're going to actually look through, we start in 30s and 40s. That might sound a little early for a lot of people that might be thinking about retirement, but really just talking about risk and try to how to line that up, because it does change quite a bit. And hey, you might need to take on more or less. It's going to be different for everyone as we talk about, Ryan, but getting this right is so important.
Yeah, it is. And you said 30s and 40s. I mean, there's a lot of people that we work with that are already thinking about this stuff, because it's I don't know if it's a trend or I don't know what exactly. I can't put my finger on it, but more and more people are wanting to retire early. I don't know if it's like a work ethic thing or if it's just, hey, we're making really good money, but I don't want to do this forever type of thing. But I'm seeing more and more people not think about the stereotypical 65 or 70 or 67 or 62. They're wanting to figure out things and how they can do it earlier, which is great. So it just depends, but a lot of people in this age demographic are starting to think about it.
Yeah, so we're going to take you through the 30s and 40s, then 50s and 60s, right before retirement, what you should be thinking about in terms of risk, and then 60s and 70s once you're in retirement. How does that approach change as well? So let's start 30s and 40s. We're on the younger side. So the aggressive one, right, feels behind, trying to make up for lost time. They go heavy into stocks, crypto. There's a lot of high risk there. The cautious ones, again, are still a little bit kind of spooked by those big swings in the market, and they have a lot in cash and in low yield accounts. And then there's the in between, consistently saving to 401ks, Roths. Not thinking about it too much. The slow and steady approach. So, which of these three at this stage do you think concerned you the most?
At this stage, definitely the cautious one, because to me, obviously there's no guarantees of what returns are going to be in the future, but just so many times you look back and you have time on your side. I know that's very easy and cliche, but you do have time on your side in your 30s and 40s. You still have maybe a long runway of work life and a long runway of life. So you don't want to get too conservative, because I get these high yield savings accounts and CDs are paying more, and they're better than they were 6 years ago or so when interest rates were so low. They can't pay a whole lot. So now that they can pay a little bit more, but it's still not money that's really outpacing inflation in the grand scheme of things. So, and that's essentially what you want. You want your money to grow that outpaces inflation. And usually I'm kind of generalizing here, but usually the best two instruments for that are real estate and investing in the stock market. So there's risk obviously in both. We all know that, but usually the regret of not putting that money in sooner, because then you look back and go, oh gosh, if I'd have done this, then I'd have this. I get it. We have the lost decade of 2000 to 2009 where essentially nothing happened. There was a lot of this, in that decade, but you almost kind of were where you were when you started. But that's really the only 10-year period that's happened to. Now, could it repeat itself? Sure. But usually there's regret on the cautious one. Aggressive, I'm not really worried about people who are trying to quote unquote catch up. I'm okay with that as long as they have the risk capacity to do that. And then the somewhere in between is fine. That's where most people lie. That's going to be, plowing forward, putting your money in your 401k, your Roth IRAs, your brokerage accounts, and just earning that paycheck and then being intentional with setting that money aside. But I would say in this age demographic, the cautious one is the most concerning.
Yeah. Look, I can't blame people for being cautious. People in their 30s and 40s have seen a lot in the market, right? A lot of ups and downs, a lot of big swings, and it's easy to kind of feel uncomfortable with that. But also I think too, if you've been through one of these or one of these big corrections, you can kind of see the opportunity for growth on the other side, which is a big part of it too. But, being too cautious early on could help you lose out on a lot over the long haul potentially. Let's shift 50s and 60s, Ryan, right before retirement. So as you're kind of starting to think about it a little bit more, but you're not quite there yet. I think the aggressive approach is still pretty similar, right? You're still heavy into growth, still wanting your money to work hard for you. The cautious approach in this stage usually is, I think, moving to bonds and more conservative funds. Really, again, you're getting close to the finish line. You're trying to protect what you built, and then somewhere between, you're looking to diversify, but also still open to some different options there potentially as well. So when I know this is kind of a demographic that you're working with quite a bit, getting ready for retirement, what are the conversations you're having with clients in terms of investment strategies and risk right now?
Yeah, I would still, in this age demographic, I would still, and maybe it's a little bit slanted toward like my personal risk tolerance, but I would still say the cautious one, again, because we get so caught up in having to be in so much fixed income and bonds when we retire or before we retire, because we can't take on the stock market risk or can't afford to take on the stock market risk. And that may be true. I'm not belittling that. It may be true, but again, you could have another 30 to 40 years of life left in you. And if you get too conservative, then you run the risk of running out of money. Just like if you take too much risk, it could make your portfolio too volatile and then potentially run out of money. So to me, it's a good mix, but I still think the one who is too cautious. And when I say, like, a lot of people are in target date funds, which, whatever, target date funds serve a purpose, I guess. But different fund families have different risks pegged to that target date fund. So a Vanguard or a Fidelity may have the same target date year, but it could be completely different from a risk tolerance perspective. So, and so many people's 401k dollars are in target date funds. So just be aware of how much risk you're taking on. But because we're maybe getting too conservative, that may not, again, outpace inflation when we have our portfolio set for us. So the aggressive one, yeah, there's some risk there for sure. But I would still say the cautious one is the most concerning for me in this age demographic, because they feel like they got to pull back the reins almost too much, and they may be missing out on some opportunity.
Yeah, and I think too, I kind of see how you lean that aggressive side too here, and I think this is kind of that range where you really want to be having those conversations, because again, somebody could be too aggressive that should be scaling it back because they're in really good shape, and on the flip side of that, somebody could be very cautious, think, okay, I'm getting close to retirement, let me protect this. But actually having a meeting and conversation with a financial professional, a certified financial planner like yourself, you can find out, okay, actually, I've got some work to do. Let me be more aggressive. Like this, it feels like this is a period of time where that conversation is super important.
Yeah, I mean, it really is. I mean, because again, everyone's going to be different when it comes to this, but I think the 50s and 60s is such a crucial age in setting the tone for what that retirement is going to look like. Obviously, 30s and 40s, you can kind of hairs on fire, putting your head down, saving. 50s and 60s, you're probably making some of your best money, probably. So you need to be very intentional on how you save that. And again, take on as much risk as you're comfortable with. But then that's our job as advisors, to help people pinpoint that and talk them through that. If they're super ultra conservative, you got to show what that does for them, but also the downside of what that does for them. So just the education, again, pouring into our clients and making sure they know the real risk of what they're taking on, whether it's too conservative or too aggressive.
All right, let's shift into our 60s and 70s. Once we're in retirement at this point, is kind of what we're looking at here, Ryan. So on the aggressive side, still, I think this is where you still have people that are investing like, maybe they're 40 in their 40s or in their 50s, still trying to build towards retirement. They don't, want to touch the principal, but they want the portfolio to keep growing. Cautious ones have now, probably pulled everything out into cash or conservative spots, trying to just protect everything they have now that they're in retirement. And then somewhere in between, I think, you're still kind of trying to figure out which accounts to draw from, trying to figure out, where that money should be pulled from. The right answer is there, but you're not quite sure what it is. So when you're looking at these, Ryan, kind of, where do you think is maybe the biggest long-term threat when you look at these different approaches to risk?
Yeah, I mean, in this age demographic, I would probably say the too aggressive. And most of the time when people are too aggressive, again, they're trying to quote unquote catch up. They've had a lifetime of not saving, and they feel like they're behind the eight ball, and they have to do this, this, and this. And sometimes that can be very concerning, because if there is a pullback, which we've seen many over in our lifetimes, if there is a pullback of 30 to 40%, that's very difficult to get back up, because if you lose 30 to 40%, then you have to earn way more than that just to get back whole. So we want to be strategic on that. Take some risks, but again, it's got to be pinpointed. That's where the education part says, hey, we're in this type of account, so we're going to be more aggressive on this one. So if it's not doing well, okay, we're not going to pull our retirement out of this. We're going to go to these other accounts. So just making sure we educate our clients on what we're taking, what funds we're selling, and what accounts we're taking out of from a tax standpoint. So being probably too aggressive in this age demographic, because when you get to this age demographic, you want consistent rate of return, not average rate of return. 30s, 40s, 50s, maybe even the 60s. Yeah, we're wanting an average rate of return, a good average rate of return. But then you want more consistent rates of return as you're pulling that money out, because that will make the portfolio last longer, because you're going to have to pull money out even when the markets are down sometimes. But again, that's where the allocation and the diversification is so important as clients are taking their money out of those accounts.
All right. Very good. Look, I mean, the bottom line is the risk is going to look different, at every stage of life. And the one thing you do is you have to be comfortable with it, right? You have to be able to be comfortable with some of the risk, because you can't avoid it. There's no way to avoid risk completely. You have to be able to kind of work that into your plan and just making sure it matches, where you are in life and where you want to go, right? That's what's so important, and why you work with the financial team that can help you with that. And again, Ryan, this risk conversation is one that you really can be having at any time. I know a lot of people start thinking about retirement maybe 5 years out-ish, but this is something really that you can really focus on early on, and it can have a lot of positive benefits down the road.
Yeah, the earlier the better. Again, you can brainwash that people all day long, but sometimes it sticks and sometimes it doesn't. But yeah, the sooner you start planning on this and really pinpoint what that risk capacity is and risk tolerance is, then you can make a better plan. It makes the plan a whole lot easier down the road. Again, like you said, 5 years before may not be as easy to plan around this stuff. But if we do this in our 30s and 40s and really pinpoint it, and my stress to people out there is, don't get lazy with your 401k. Don't just think, oh yeah, I got certain percent in there. Like, pay attention to it. Like, know how much you're putting in there. Know what the match is. So many times I've seen people who don't know how much they're putting in, don't know how to get the full match, and they don't know what maximizing in the 401k is, or maxing out a 401k. Maxing out is not just getting the match. It's trying to go up to the contribution maximum limits that the government allows you to do. So know the difference, and take advantage of those catch-up years. When you turn 50, you can put more in your 401k. Between the ages of 60 to 63, you can put more in your 401k. But also pay attention to the investments in there. I know the investments are limited. That they do that on purpose, so it's not paralysis by analysis. So you have too many funds in there, but know what funds are in there, and don't just think a target date fund is going to get you to the goal that you want. Maybe it will, but don't just assume that. Know what it is and be educated on that. So know your 401k, or whatever the retirement plan is, 401a, 403b, SEP IRA. There's so many different ones, but just know what it is and know how to maximize, put the most you can in there, get the most match you can, and know what investments are in there. I just see too many people not pay attention to that.
Yeah, well said. And look, that's why if you want to, have your portfolio reviewed, right? See if your 401k or those retirement accounts are being invested properly, and make sure you have the right amount of risk as well. That's an opportunity now to talk with Black Oak Asset Management. They can help look over that, give you that review, assess kind of where you stand, and help you better understand what decisions to make going forward, and what kind of plan to have in place for your goals and where you want to go. Again, go to speakwithryan.com to get on Ryan's schedule, but all the other contact information is in the show description as well. Well, that'll do it for us here on Perfect Game Retirement. Appreciate you watching or listening. Wherever you are, please subscribe. We appreciate that support as well. We'll talk to you again on the next show.